Hello again. For those of you who are just now joining us for session 3 of the Trends in Asset Management Conference, my name is Linda Bowie, and I'm the Senior Associate Dean of the Brandeis International Business School and an Associate Professor of Economics. We're about to kick off our third and final discussion of the day, a panel featuring researchers from both academia and the Federal Reserve. Specifically, we'll be taking a closer look at both the impact of sea level rise on municipal bond markets and the impact of new carbon taxes on stock prices. Our moderator for this session is Brandeis International Business School's own Dan Bergstresser. Dan is an associate professor of finance and the co-director of the Rosenberg Institute of Global Finance, chair of Brandeis University's undergraduate business program, and a member of our own asset management council. Joining Dan will be Marcus Painter, Michael Swartz, and Marcelo Ochoa Coloma. Marcus is an assistant professor in the Department of Finance at St. Louis University. Michael is an assistant professor of finance at the Wharton School at the University of Pennsylvania, and Marcelo is an economist with the Federal Reserve Board. I know we're all looking forward to this discussion. Dan, please take it away.
Great. We're thrilled that you can be here to see this, and we're incredibly thrilled that we have, I think, 3 of the really top young economists who I'm thrilled are thinking about a topic that is extremely important, which is the relationship between climate change and financial markets and the economy. The way that this is going to proceed, so it'll be a little bit different in the sense that each of the authors is going to be presenting their academic research. We wanted in this conference to put together high quality ideas, innovative ideas from practitioners and innovative scholarship. And so I will turn it over. Each of the authors is going to present their research for about 14 minutes. There's a Q&A box. So if you have questions for these researchers, you can send them to the Q&A box. I'll do my best to curate some of the questions that come in, but without any further blabbing from me. I'm going to turn it over to the first speaker now, who is Mark Painter at St. Louis University.
Thanks so much, Dan, and thank you, Linda. This is a great opportunity. It's also kind of a unique one for an academic to get to present something that's published. We usually do this before we publish it, and then we forget about it forever. So it's nice to reflect on some work that I've done a few years ago. So the work that I looked at was trying to quantify whether or not the market prices climate risk. When I first began thinking about this, I was reading a lot of different news articles. This is a very widely covered topic. It's been so for a long time on how climate change is affecting a lot of different things within our own lives. So things like affecting agriculture, humanitarian crises, or extinction of certain wildlife. But then there's a gradual shift into the actual economic effects of this. So what are the actual financial losses posed by this for investors, real estate owners, and beyond? And this started to grow into how shareholders start to think about climate risks as well. So if we have these economic damages, it might affect how we price certain types of financial products. So one example from a few years ago was with Berkshire Hathaway. So they were this was brought to their attention through a proxy vote from their shareholders that was asking them to start to report their climate risks annually, specifically about the insurance premiums that they had through several of their subsidiaries. And at the time, they didn't think this was necessary. So if you think about what you will see in an insurance policy, this is a annually updated risk profile. So if you have any increases in climate risk, you're going to reprice that annually to reflect those changes. So any increased losses are going to promptly be just translated into increased premiums. But if we think about other types of investments in our world, there's things that are more long-term in nature and things that aren't going to be able to get away as swiftly from this type of risk. So that's what brought me to think about this idea of long-term risks of climate change. What investments will we see affected by this earlier on? So if you think about a long-term investment where we can't really get away from physical climate risk damage, what is that going to do to that investment? And does the market actually price this risk? So a natural place to go to think about this type of risk would be the municipal bond market. So it's a very useful setting to think about this for a few reasons. So first off, municipalities are immobile. So if you think about trying to price physical climate risk through a corporation, they can actually adapt to this by moving. So if you think about, say, the Folgers Coffee Company, one of their biggest factories is in New Orleans. So if they thought that sea level rise was going to be a big enough risk to that factory, they could close up shop, go open up a new one more inland, and then long term, they're not going to face that much physical climate effects. But if you think about Orleans Parish, so for example, this image here is of a parking garage in New Orleans. Can't really move that. That's going to be exposed to this risk, and it's something that they're going to have to deal with because they can't up and go to another area. Another thing that's really nice about the muni bond space is that we have this heterogeneous term structure. So because specifically, if we think about sea level rise, a lot of the risks are more long-term in nature. It's natural to expect that long-term bonds should be more affected by this than short-term bonds. So I can exploit that when I'm trying to test this. And then lastly, because these municipalities are immobile and they're in geographically different types of places, they're going to have heterogeneous exposure to climate change. So specifically, the type of climate risk I'm looking at is sea level rise, and I'll use a measure of expected damage from sea level rise. And you'll, as expected, you're going to see more coastal counties affected by this. But then even when you're thinking about coastal counties, some are going to be projected to be more affected by this than others. There's a lot of variation to explore when trying to pinpoint this type of climate risk in the muni bond setting. So narrowing down that research question to this specific setting, I'm simply just going to look at whether a higher exposure to potential sea level rise is associated with a higher cost of borrowing for municipalities. And throughout my research process on this, so this was started way back in 2016, some growing interest came around the damages that are going to be posed by two municipalities. And we had credit rating agencies start to comment on this. So Moody's came out in 2017, threatening downgrades to counties that are exposed to this climate risk that weren't trying to address it. And consistent with that, what I mentioned a couple of slides ago, they emphasize that the physical effects of climate change are going to be more for long-term bonds, and it's also going to vary based on the magnitude of impact from the climate risk. So that's a good motivation to think about trying to structure how we identify this climate risk for municipal bonds. So motivated by that, when I'm trying to think about the specific cutoffs for identification, just thinking about any type of long-term bond that's going to be more likely to be exposed. So any revenues that bond will get, or the actual physical structures that might be financed might also be damaged by this long-term risk. That's going to be bigger for the long-term bonds than for the short-term bonds. So I'm just going to look at those different subsamples. So specifically, the main cutoff I'll use is bonds with a maturity greater than 25 years are going to be my long-term bonds, and those less than that are going to be my short-term bonds. Of course, any cutoff here is going to be somewhat arbitrary, so I just ensure that these results are robust to other term structure cutoffs as well. As far as the magnitude of impact, I'm going to look at the mean annual loss as a % of GDP for the specific counties where that municipality is issuing the bond. So I take from the climatology literature. This is a paper from Nature Climate Change by Halagate et al. So just a little bit about how they make their projections. They're going to assume 40 centimeter sea level rise by 2050 and kind of gradually going towards that throughout time. And they account for quite a few different determinants within their projection. So they look at things like what type of infrastructure does this county have, how much would get damaged, what lost economic activity might we have from that. But they also incorporate things like population changes or projections and population changes throughout these periods, as well as human-induced subsidence. So not just the sea level rise, but also the land sinking somewhat. So I'm going to take this climate risk measure and bring it into the municipal bond primary market. So specifically here, I'm going to be looking at primary market issuance data from 2004 to 2017. I'm mainly interested in whether or not municipalities have to pay more. So do the underwriters charge them more to actually finance these bonds? And then do they have to pay more to investors in order to get them to buy these bonds that presumably have higher risk than otherwise similar bonds that don't have climate risk. So let's just jump right into the main result here. So I find what I've proposed essentially. So long-term issuance costs are higher in counties with higher climate risk. So the way I look at this is just a simple regression framework using that climate risk measure. So this is, again, the mean annual loss as a percentage of GDP for a county. That's going to be my key independent variable of interest. And I'm going to look at whether that affects my dependent variable, which is your total annualized issuance cost. So including both how much we have to pay to investors through the initial yield, as well as how much we're paying our underwriters through the annualized gross spread. And I'll control for a host of bond controls. I'll have state by year fixed effects. So we're looking within the same state and year when we're comparing these things. And then I'll also cluster my standard errors by county. So when we get to the regression results, just showing a few of them here, you'll see that the effect is driven in the long-term issuance bond area. So climate risk is strongly associated with the issuance cost for long-term bonds, but no strong effect for the short-term counterparts. As far as actually interpreting these coefficients, I'm just going to jump to the second bullet point here. So if you had the average bond, a 1% increase in this climate risk measure is associated with a rise in your total issuance cost of about $83,000. And now, given the average county issues about 26 long-term bonds in my sample, if you think about the aggregate additional burden for these counties, it's going to be about $2.15 million per year. So this is how they have to entice these investors and other market participants to trade with them, given that they have this higher risk for these long-term bonds. So the next part of this paper goes into some heterogeneous effects. First off, I want to look at whether or not Moody's threat of climate downgrades is necessary, or if the market's going to be able to price, heterogeneous effects based on the credit quality of a municipality. So if you go back to Moody's comments, they noted that higher rated sovereigns are probably not going to have as much trouble with climate risks because they have more diversified economies, stronger infrastructure, et cetera. Whereas sovereigns that aren't highly rated, they're going to have weaker infrastructure. They're not going to be able to withstand the climate effects. If they have maybe insurance payouts coming out later, maybe they don't have the liquidity to survive to make it to those insurance payouts. So that's really where the effect should be concentrated. So I'm going to look into that. So do investors actually account for this credit rating heterogeneity? Because if the market already recognizes the greater effect of climate risk on these low rated bonds, that would imply that the market recognizes the risk on its own, and we don't potentially need those Moody's downgrades because the market's already pricing in this effect. So the way I look at this is through another sample split. So let's look at the high grade bonds that are long term. So I'm just going to take, AA- bonds or higher are going to be high grade bonds, and we'll hypothesize that the lower grade bonds is where this effect is driven. And that's what I'll end up finding, and it's going to suggest that the market accounts for differences in credit quality by requiring a higher yield. So they actually already see that this risk is happening. So potentially we might not need the adjustments from the credit rating agencies. So specifically, when we look at the splits, when we are looking specifically at long-term bonds, the lower credit rating bonds, so those below a AA- rating, is where you see all the action. So it's stronger in this area if we think about the magnitude of the coefficient, whereas we see insignificance for both highly rated long-term bonds, and then for any type of short-term bonds, we still don't see any effect in terms of climate risk affecting issuance costs. So the last determinant I look at in this space is attention. So for investors to actually price this effect, they have to acknowledge it and incorporate it into their models about how risky this investment is. So what I'm going to do here is a diff and diff model around one of the bigger studies put out around the economics of climate change. So there were prior studies more focusing on is climate change occurring and things like that prior to this study. But this Stern review, which was written by Nicholas Stern, in 2006, was one of the earliest and most thorough analyses on the economics of climate change. So what's the actual economic damage which is what people might start to price in when they think about this risk for municipalities. And importantly, it's not really going to affect the risk profile of munis when this paper comes out. It's just going to affect whether or not investors might be aware of climate change risk in their own models. So whether or not attention is important for pricing this climate risk, this is a nice setting to try to exploit that. So I do this in a regression framework. I'm just going to show you the picture of it around the actual date of the Stern review. So what I'm showing you here is the difference in issuance costs. So how much does it cost to issue that municipal bond, both before the Stern review, then this vertical line is the date of the Stern review, and then afterwards. And this line is just comparing the issuance costs for bonds that have climate risk versus those that do not. And you see that they're pretty close to zero. There's not a very big difference prior to the release of this report. And then we see a steady increase afterwards. So it does seem like attention is important in this setting. So I realize we've got a lot of practitioners here that want to learn more about all these different determinants of climate risk. I also wanted to pull in some other work that's been done since this paper or concurrent with this paper to give a little bit more perspective on other instances that are happening within this field. So I pulled the connected papers of my work. Connected Papers is a really nice website that lets you link the citation networks of different papers, so, who's citing whom within their bibliographies and whatnot. So for example, you can see some of our panelists here. So you see Michael's down here because our work is related. You see a paper by Marcelo is also up here. So I just wanted to highlight a couple of these that might give a bit more perspective on climate finance research. So first off, there's Dan's paper. So our esteemed chair today has a paper looking at green bonds. So specifically, what they look at is these types of bonds that are actually created to fund environmentally sensitive projects. And what they find is that these bonds are actually issued at a premium to otherwise similar ordinary bonds. So it's kind of thinking about it like a luxury good, so almost like organic food. You get this warm glow from purchasing it, so you're happy to pay more, and you see this similar outcome for investors for environmental bonds. Another interesting paper looking at attention around investing here. So this is Choi et al. They find that when local temperature is abnormally high, you see stocks of carbon-intensive firms underperform firms with low carbon emissions. But it's that attention component that's really important here, because when people feel the abnormally high weather, they're more likely to think about climate change and things like this. So they're more likely to price it into their investments. So just a couple more here. Another piece of a good determinant of whether or not this is going to be priced is whether or not people actually believe in climate change. So this Baldoff et al. Paper looks at the housing market. They find that houses projected to be underwater in believer neighborhoods, so those that are exposed to sea level rise risk, and areas where people believe in climate change, they trade at a discount relative to houses also exposed to this, but in climate denier neighborhoods. So you have to believe in this as well to try to actually have it priced in whatever market you're looking at. And then lastly, I know I'm probably out of time here, but this is a very important paper thinking about how institutional investors think about climate risk. So Kruger et al. Looked at a survey of what institutional investors think about this. And this was done, I believe, in 2019, and it looks to see that institutional investors are already starting to think about climate risk, particularly regulatory risks, which we'll hear more about from Marcelo today. And they think risk management rather than engagement, or risk management and engagement are the ways to try to address climate risks. And that there's some push towards having more climate risk disclosures. But thank you again for the time. Again, the paper I looked at was looking at long-term municipalities. Their issuances are more costly when they have more climate risk, and market attention and the credit rating of that municipality are important determinants of whether or not it's priced. Again, thank you for your time. I'm happy to talk more about this, and I'm looking forward to the rest of the session.
Yeah, thanks very much, Marcus. So there's a number of questions are coming in via text message. There's one question that is coming in the chat from Anna Sherbina, and she's wondering, what was your thinking behind focusing on the primary market versus looking at both the primary and the secondary market?
Yeah, that's a great question. So my initial thoughts about this, I came from actually trading primary municipal bonds before I started academic work. So it's kind of a natural place to look at for me. But what I was really interested at the time was how do we motivate these local economies to try to actually potentially address these things? And if they have to pay more, then maybe that's going to motivate them to maybe affect their exposure to climate risk. So, if things are trading in the secondary market and I'm a municipality, I already got this money. I just have to make sure to pay it back. Whereas at the funding part, that's where I'm directly having to pay for this, primary issuance of the bond. So it's a more direct look at what the municipalities are doing.
And this relates to another question that's come in on text as well. Is that also behind the inclusion of the gross underwriting spread?
Yeah, exactly. Yeah, so that was the theme there. But there's a great paper looking at the secondary market that if you stick around, you'll get to see that flavor as well.
Actually, if you stick around for exactly a minute or two, yeah. I want to actually we've hit the transition time to the next paper in the session, and it's kind of an interesting situation because these are two papers on broadly a similar, maybe the same topic, some different wrinkles in the focus, coming to some different conclusions. I think they can be reconciled with each other. But I think it's interesting for people in this audience, which includes a mix of practitioners, academics, people connected to Brandeis, to sort of peel behind the curtain on what research in the real world looks like. And so I'm going to turn it over now to Professor Schwartz to talk about the same topic, but looking with some different wrinkles in the way that he's focusing on this question. So take it away, Professor Schwartz.
All right, thanks, Dan. And thanks, Mark, for providing great motivation on this research question. I don't have to spend too much time talking about what motivates our paper. So this work is co-authored with Paul Goldsmith-Pinkham at Yale, Matt Gustafson at Penn State, and Ryan Lewis at Colorado. This is a paper that, to be perfectly honest, we started after Mark started his paper. We embarked on the project and then came across Mark's paper, and we learned a lot from reading it. And as Dan noted, we've come to a slightly different approach to studying the question, as well as some slightly different results. And so I think it'll lead to an interesting discussion. Mark motivated the question quite well. I mean, obviously, many people are concerned about climate change. The motivating plot I'll provide here is data on scientific projections of sea level rise going forward. So we're studying the same research question, which is how sea level rise impacts municipal bond yields. The plot here is showing, as everyone's probably aware, projections of sea level rise have worsened over time. And so this is showing the distribution from a sample of studies that we pulled data from for our paper. We're actually in the process now of expanding this sample. And so it's showing the first percentile, the average forecast, and the 99th percentile, or the worst case forecast, across studies that were published over the previous few years at each point here. And so we see that over time, I mean, around 2006, 2007, as Mark noted, we see worsening forecasts, and then we see dramatic increases in forecasts as we move toward the present, both in terms of the level of the average forecast, moving to nearly 4 feet of global average sea level rise, as well as the worst case projection and the difference between the worst case and the best case scenarios, which is going to be one focus of this paper. In addition to sea level rise in the long term, some experts are forecasting worsening storms, tropical storms, and associated flooding. And notably, as we show in the paper, popular interest in this issue is rising. Right? If you look at Google search trends, they go up in exactly the same way that these forecasts go up over time. And so the research question in this paper is what the expected economic costs of sea level rise will be for coastal communities. We expect these costs, of course, to be incurred if and when in the future these communities are inundated, but these costs could occur in the nearer term than that, even nearer than the 25-year cutoff that Mark was looking at, because we're already seeing forward-looking behavior by residents of coastal communities as they relocate to further inland areas. Understanding these costs and measuring them is important to understand the benefits of climate remediation efforts, of course, as well. And so the venue we're going to look at this question in is the municipal bond market. So financial asset prices provide a forward-looking measure of future cash flows, expectations about future cash flows rather. Bond credit spreads are particularly interesting because they're going to provide a measure of downside risk, right? Bond investors don't care at all about what the growth is going to be in a community. They only care about the likelihood of economic conditions being bad enough that the bonds will not be able to be repaid. We're going to look at school district bonds. These are going to be defined strictly by geography, and they're going to be tied closely to the underlying assets. And this is going to provide us an opportunity to translate the asset price changes we're going to measure in the data directly using a model into some real economic effects that we can compare to estimates that are coming from the scientific community. And so there are two parts of what I'm going to show you, and we have a short amount of time, so I'll move into it quickly. First, I'm going to estimate the effect of sea level rise exposure on municipal credit spreads. I'm going to use detailed local variation by school district and school district bond yields. I'm going to compare issuers that are located in the same county and seeing their bonds traded in the secondary market in the same month. And so this is going to contrast with what we saw before, which was focused on the primary market. Now we're going to be focused on the secondary market as a measure of what investors anticipate about the risks of these bonds as they evolve over time. And since these are after the bonds are issued, any inference will be robust to decisions that are made by the issuers as to whether to sell the bonds at all, what types of terms to include in the bonds to potentially induce investors beyond price terms. Then I'm going to apply a simple framework of credit risk to try to translate my yield estimates into economic terms. This is going to be based on the Merton model, which is effectively an option pricing model for debt instruments. And so to give you a preview of what I find, I'm going to find that sea level rise exposure is associated with slightly higher muni bond spreads. The effects are growing over time. So just in line with that plot I showed you of scientific forecasts, the yield effect in the municipal bond market is increasing almost exactly in line with that. Now, the effect I find is going to emerge after the financial crisis. In 2013, it becomes significant, and it starts to emerge in 2011. This differs a bit in terms of the timing. Mark's effect basically arises during the financial crisis. And of course, there are no sort of annual estimates in the paper, but I'll provide those here. In terms of magnitude, one standard deviation higher sea level rise exposure, and I'll define how we measure this, is associated with 5 basis point higher municipal bond credit spreads. This is a small effect on borrowing costs for municipalities. There's no other way of framing that. Now, in terms of the economic impact this implies, this is also small, but potentially non-trivial. This implies either a reduction of 2 to 5% in the present value of local government cash flows going forward, or a proportional increase of about 2 or 3% in the volatility or uncertainty of these cash flows. Now, when we do some auxiliary tests, we land on uncertainty as the key driver here. Specifically, we don't really see effects on house prices at the school district level. And this is going to contrast from what we see in the literature on house prices at the individual house level. If we think of houses as essentially being the underlying asset for a school district, which derives its revenues from property taxes, then this suggests that it's not really about expectations about cash flows, but rather that left tail risk that municipal bonds are able to pick up, but assets are not able to pick up because they're not sort of options on that underlying cash flow stream. And so the data we're going to use run from 2001 to 2017. We're going to focus on school district bonds. The natural reason for this is it's going to provide a very small and well-defined geographic area over which we can measure climate risk exposure. This also is a large segment of the muni market. So this is about 30% of new municipal issues over our sample period. We'll restrict to tax-exempt bonds. We're going to require at least 10 trades in the MSRB data. This is requiring a minimum amount of liquidity in the data. We can't really do much with a bond that only trades once or twice. We're going to balance our panel, so we'll restrict the sample a bit further. We're going to require at least 1 district per county is going to have bonds trade, and at least 1 trade per district year. This is going to throw out Florida because bonds get issued at the county level in Florida. Then what we do is we compute a volume-weighted credit spread over the AAA tax-exempt curve for each issuer, or for each bond month observation, rather. Then we merge issuers to geographic data on school district boundaries, and we're restricting attention to coastal counties to ensure some uniformity. So there are no inland counties in our sample for this paper. It's just comparing school districts that are closer to the coast and more exposed to sea level rise versus those that are close to the coast but less exposed to sea level rise. And so the key variable on the right-hand side of our tests is going to be the fraction of properties exposed to 6 feet of sea level rise. we're using maps from the the NOAA that offers precise maps at the property level of sea level rise exposure in the US. And so this is an example of the kind of data we're looking at. This is Fairfield County, Connecticut. Each black dot here is an individual property from Zillow Z-Trax. We map each property using the NOAA data. The green area here is the area that's exposed to 3 feet of sea level rise. The blue area is the area that's exposed to 6 feet of sea level rise. And the red lines here are school district boundaries. And so what we do is we just sum up the properties that are covered by the blue area, divide it by the total number of properties, and that's the fraction of properties exposed. If we do this by the market value of the properties, it makes no difference in terms of our estimates. And to zoom out a bit, this is what SLR exposure looks like in the Northeast. This is where a lot of our results will come from because the biggest issuers, the biggest states in the sample are going to be New York, New Jersey, sort of states that are on the Northeast coast there, since Florida is going to get kicked out of the sample. As a side, we're also kicking out California. There are 2 reasons. First, Prop 13 basically eliminates the sensitivity between underlying property values and municipal bond risk. And secondly, there's actually a state organization in California that serves as a conduit for school financing. And so that could also contaminate the correlation between local exposure and bond yields. And so in terms of the sample, 2 things to highlight. One is that the sea level rise exposed districts in the sample naturally have greater exposure than the ones that have no properties exposed. The yields are actually pretty similar across them before we do any regression analysis, though, both about 3.2%. These are tax exempt yields. They have credit spreads of about 55 to 60 basis points over the AAA curve on average, and about 10 years to maturity on average. Okay, so our goal here, identify a causal effect of sea level rise exposure on credit spreads. What we want to do is estimate this over time, because as I showed you before, these forecasts are worsening over time. And so it's important to assess how the pricing effects have changed over our sample period. And so we estimate this regression of spreads on county time fixed effects. So we're comparing issuers in the same county trading at the same time, issuer fixed effects to control for any time invariant unobservables, separate yearly coefficients on our sea level rise exposure measure at the district level, as well as some time varying controls for the term structure, for callability and the value of bond insurance, which has changed over time. Specifically, the monoline insurers collapsed in 2007, and that could have differential effects on issuers in our sample. And then we have some time invariant controls. And so this is what the main regression estimates look like. And I'm just going to show you a plot that shows you the estimates year by year with 95% confidence intervals. This is the fully saturated regression with all of those controls that I showed you earlier. The the y-axis here is the effect of a 1 standard deviation or 10% increase in the fraction of properties exposed to sea level rise on the municipal bond credit spread. And what we see is that there's basically no effect through the financial crisis. And in some ways, this lack of an effect during the crisis gives us some comfort, because this shows that our identification strategy is doing a good job controlling for location by time unobservables, right? This is a time when there's a lot of variation, a lot of heterogeneity in municipal credit spreads across places, but we're not seeing that correlate with our sea level rise exposure measure. Now in 2011, we start to see an effect tick up. And then by 2013, 2014 especially, we see a statistically significant effect that indicates a 1 standard deviation increase is consistent with about a 5 basis point increase in credit spreads. So going from that average of about 55 bips to more like 60 bips. So about a 9% increase relative to the mean. Now, there are both long run and short run risks that our sea level rise exposure measure could be picking up. In the long run, oceans could inundate coastal properties. In the short run, we have storm risk. We add a measure of storm surge exposure to try to tease this out. And it shows up in intuitive ways. I mean, in the long run, sea level rise matters. In the short run, both SLR and storm surge could matter. But this is highly correlated. These 2 measures are, and so it's difficult to disentangle their effects. Now, in terms of interpreting the estimates, I'm not going to have time to go through the model in detail. Essentially, what we do is we apply an option pricing model that's used in the corporate finance literature. We apply it in the municipal bond context. There's a lot of discussion in the paper as to why this is applicable in this context. But it basically gives us predictions that either are in terms of the underlying asset value backing the bonds, sort of the underlying stock price is an option pricing model, or the volatility of the underlying cash flows. And so we're seeing that this 5 basis point change corresponds to either 2 to 5% in terms of asset value or 2 to 3% higher volatility. Now, when we control for house prices, they have no effect on our estimates. We also don't see, when we put house prices on the left-hand side, house prices aggregated to the school district level, that sea level rise exposure loads significantly in the regression. And so the bottom line seems to be that sea level rise, the effect on yields rather, is driven by uncertainty more than asset values. Now, finally, to wrap up, we find effects consistent with the house price literature in the sense that these effects are strongest where people believe about climate change. You can do state-by-state tests in the municipal bond market because we essentially have 50 segmented markets that are governed by in-state tax privilege. We also see bigger effects where school districts rely more on property tax revenue. So where the bonds are actually tied more closely to the underlying real estate in the districts. All right, so with that, I'll wrap up because I don't want to throw us off schedule here. Happy to answer any questions.
Thanks very much, Michael. There's a question that's coming in. This is from Debarshi Nandi. Is there heterogeneity across the different school districts in your sample and the extent to which you have the penetration of private insurance for properties that would otherwise be unrepairably damaged by a storm? Like, do you see, like, within an SLR bucket, do you see heterogeneity in insurance?
Yeah, that's a great question. That's one of the things that we're working on gathering data on. And so I don't have data on that at the moment. One thing to note is that we do control for district fixed effects. So to the extent that we could take out the average sort of insurability in a district over our sample period. But of course, if there's time variation in insurability that's correlating exactly with these yield effects, you could see that as an argument as to why we're seeing that. Now, one thing I think that would undermine that is that we don't see effects on house prices, right? So if it was that you can't insure your house, you would think that house prices would go down as a result of that. Not only, I think you're thinking about property tax revenues, but of course the house prices themselves would also go down. And we don't see that at all in the data. And there's a thorough sort of battery of tests in the paper showing that you can refer to. And so I really think it's this left tail risk that we're picking up and not related to things that would impact homeowners today.
Another question coming in. Is there something about school districts that makes school districts special? If you think about the range of things that are financed with municipal bonds, you've got a range from most essential to kind of least essential. So like, I don't know what you think of like a hockey arena, but like you've got some uses of municipal finance that are arguably less essential than schools. And would you think that you might find differences as you look across the range of different?
So for one, I think it's absolutely possible we would see different effects in different segments. I want to be clear, we're not using school districts because we think school districts are the most economically important thing that would be impacted by climate change. Mm-hmm. We're using them because they are confined to sort of the narrowest geographic areas that are common across states for municipal finance. And so they give us a good measure of the climate risk or sea level rise exposure of each issuer that we can measure very tangibly, right? And so we're measuring the climate risk exposure directly and then trying to back out the economic costs implied by bond yields. And school districts are sort of the laboratory in which we do that. But there's nothing special about schools otherwise in terms of what we're thinking of.
Fantastic. This has been really great. I want to transition now to the final speaker that we have. So we've got Marcelo Ochoa Coloma from the Board of Governors of the Federal Reserve System, moving us from the world of municipal finance in the United States to equity markets in Europe, but also thinking about the extent to which issues related to climate and carbon taxes are reflected in capital markets and in asset prices. So take it away, Dr. Ochoa Coloma.
Thank you, Dan, and thanks for the invitation, and to the folks that are virtually joining us today for your interest in our panel. This paper is co-authored with Matthias Postian and Laura Wilcox, both colleagues at the Federal Reserve Board. So I need to first say that all analysis and conclusions in my presentation are my own and do not reflect the views of the Federal Reserve Board. As you know, as we've been hearing, during the afternoon, I was joining, and as the previous speakers also said, there's a lot of concern about climate change. In survey our survey that I read, global investors are reporting that climate change is in the area of greatest concern among environmental issues. And what type of risk are investors concerned about? What we see is that they usually, climate change is expected, for example, as we heard before, to, for example, increase intensity of extreme weather events, as well as Mike has shown, cause sea levels to rise. And the uncertain economic losses from these adverse trends are referred to as physical risks. The uncertain scope of the policy responses at the same time and the pace of technological innovation needed to transition to a carbon neutral economy also give rise to risks, which are usually called regulatory and technology risks. And we also shift in preferences away from high carbon products, and there's a growing interest in financial market innovations that fund adaptation to climate change, such as green bonds, which we have been mentioned during the panel before. So those are also a source of risk. So it's no surprise that investment strategies that screen companies based on some environmental criteria have grown dramatically over the past years. As you can see in the chart here that I take it from the Sustainable and Responsible Investing report, there's about like $16 trillion of assets managed by money managers and financial institutions in 2020 that they report as systematically and explicitly considering climate change and carbon emissions in the portfolio selection and management. That is like a more than 50% growth since 2018 and represents about 30% of total assets under professional management. And this trend reflects not only a shift in preferences toward investment opportunities that kind of will help contain the climate crisis, but also a growing concern about the risks that I mentioned from climate change. Even so, we don't see any systematic empirical evidence that investing in companies with high environmental ratings or sustainable theme products is a good climate risk hedging strategy. And there's just one simple reason. The physical risks from climate change have not yet fully materialized. There are forecasts, as Mike showed, for example, but we haven't seen them materialize at this time. And at the same time, policies to combat climate change, like carbon taxes, usually take a long time until they sign into law, so they're usually widely anticipated. In this paper, we sidestep these limitations by analyzing the performance of simple dynamic investment strategies that intend to hedge climate change risk around the exogenous changes in expectations about the level of a carbon tax. In our analysis, what we do is we exploit the events leading to the approval of the German carbon pricing system for the transport and building sectors in December of 2019. The passage of this legislation is a unique quasi-natural experiment, we believe, because it helps us study the hedging properties of a simple investment strategies when there is a realization of a transition risk. Let me briefly explain why. So let me tell you about the event. In November of 2019, the German lower house of parliament approved a pricing system for carbon emissions. And you can see the level of the pricing system in the gray line in the chart. And it was expected to pass the upper house in December of 2019. However, the upper house requested to negotiate the distribution of the revenues that were coming from these taxes. And the pricing scheme that you see in the chart was not under negotiation, just how they were gonna distribute the revenues between the states in Germany. But after debating all the weekend of December 15, they came out overnight and lawmakers said that they agreed to raise the initial carbon tax from the gray line to the green line. So the initial carbon tax was going to increase from 10 to 25 euros per ton of carbon. And they also agreed, to increase the carbon tax over time. Both of these actions came as a surprise to financial markets. And moreover, by setting this higher carbon price, even though it was targeted to specific sectors, it also signaled an increased likelihood of further policies to reduce carbon emissions in Germany. So we would expect like a cross-firm heterogeneity in the reaction to the carbon tax news beyond the sectors that are targeted by the climate package carbon tax. So this is our kind of natural experiment where our assumption is that the carbon tax news was both largely unexpected and was the main shock driving asset prices around December 16. And these qualities make this an event very well suited to explore the hedging properties of basic investment strategies. So let me now proceed and tell you what we do. So what we do is we analyze the performance around the carbon tax news of two dynamic investment strategies that incorporate ESG scores or carbon emissions directly into the security selection process. So we first take a look at one popular strategy that uses the environmental pillar of the ESG score to rank companies to remove or underweighted stocks in a portfolio. We also look at another strategy that's very popular as growing number of companies are disclosing their greenhouse gas emissions. And investors, what they're doing is trying to reduce the carbon footprint of their portfolios and produce fully or partially decarbonized portfolios. Again, by underweighting or excluding stocks depending on their carbon emissions. We use a tool that's very common in empirical finance. We form characteristic sorted portfolios. So we rank portfolios, you form portfolios ranked by either a firm's environmental score or a firm's carbon emissions, which are used by investors to proxy for how exposed the portfolios are going to be to climate change risk. If these dynamic investment strategies are successful and are a good hedge against the climate risk, so investors would expect that in response to the higher than expected carbon tax, portfolios with low environmental score or high carbon footprint would decline in value more than those with higher environmental scores or with a lower carbon footprint. While it is likely that the carbon tax news was the main shock driving asset prices around December 16, we try to isolate the portion of risk that cannot be fully diversified, and that is explained by other known risk factors that are likely unrelated to climate risk. And we do that using a factor pricing model to obtain a measure of firm level risk-adjusted returns that we're going to use to form the portfolios. Specifically, what we do in our empirical exercise, we use the three-factor model of Pham and French to obtain risk-adjusted returns. So climate-related risks are unlikely to be the key drivers of, for example, the premium between the small and big firms or value and growth firms. So controlling for this risk in these variables will likely reduce the noise in stock returns that are unrelated to carbon tax news. That will help us improve the identification of the impact of transition risk within the event study window. We also adjust returns for differences in average performance over the year preceding the carbon tax news, because that can help us adjust. What we're trying to capture is the potential rise in value of stocks with high environmental scores or low carbon emissions due to increased investor demand because they're shifting their preferences, for example, to environmentally friendly stocks, and that before the carbon tax. So it's not reflecting just a trend of investors going into more environmentally friendly stocks. So let me now jump into presenting the main results of from this exercise. In the table in this slide, what I'm showing is the risk-adjusted returns on 3 portfolios around the carbon tax news. As you move from the left to the right of the table, the firms are grouped into each portfolio based on their environmental score. The constituents of the A-rated portfolio have a score of A or higher, while the stocks in the C-rated and below portfolio have the lowest environmental score. And the last column reports the return spread between the portfolios with the highest and the lowest environmental scores, which correspond to a strategy that is long stocks of highly rated firms and short firms at the bottom of the environmental score distribution. And in brackets, we report a 90% confidence interval for the spread in returns. As you move from the top of the bottom to the bottom of the table, you can see that our analysis assesses the performance of these characteristic sorted portfolios over 2 events windows. One, a 1-day window, which is the immediate reaction to the carbon tax news, and also a 5-day window, which is the time between the news were released and the passage of the climate carbon tax in the upper and lower house of parliament. So all the uncertainty, by the time of day 5 about the level of the carbon tax should be gone. As you can see, our source on environmental scores provide little evidence that if you hold a portfolio with the stocks at the top of the environmental score distribution, is going to hedge the realization of the climate policy risk. If you focus on your attention to the first row, you see that the portfolio with the A-rated stocks does not seem to have higher returns relative to the portfolio holding stocks with low environmental scores around December 16. In fact, you can see that the C-rated and below portfolio seems to outperform after the carbon tax news. And this superior performance, just by looking at the return spread between the high and low environmentally rated portfolios, though it's small, is statistically significant. Over the longer event window, as you can see in the last row, the return spread between the A-rated and the C-rated and below portfolios is not statistically significant. Overall, the results are generally unsupportive of effectiveness of investment strategies using environmental score to screen companies or form portfolios to hedge risk from policies to combat climate change. The picture changes when we look at carbon emissions. In this next table, we examine the stock market performance of 3 portfolios sorted on what we refer as carbon intensity, which is the share of carbon emissions relative to the total value of assets. And we have 3 portfolios. We have ones that we call low emitters, which are firms in the bottom 30% of the distribution, neutral, which are in the middle 40%, and high emitters, which are firms in the upper 30%. As you can see in the first row, our sort of stocks on carbon intensity produce a strong negative relationship between the stock market response to the carbon tax news and the carbon footprint of the portfolio. The spread between the low and high emitters is positive and statistically significant. The estimated spread suggests that the strategy that goes long low carbon intensity firms and short high carbon intensity firms leads to a positive return of 0.8% the day of the carbon tax news, which is statistically significant and represents around 2/3 of standard deviation of the risk-adjusted returns over this event window. You can also see that the spread increases in magnitude with the event window. If you look at the second column, the last row, but an important fraction of the response seems to occur the day of the carbon tax news release, which tell us that this was really the event driving the response in stock prices. Overall, this seems to suggest that these strategies that screen companies based on their carbon emissions are likely to produce a good hedge to the implementation of policies aimed at fighting climate change. The portfolio sorts that evidence that I've shown you, are consistent with 2 hypotheses. why are we seeing this reaction? We can see that it's possible that investors are asking lower discount rates for environmentally friendly companies. So there's a increased investors' preference and demand for these low carbon stocks, or it can be also the case that they expect lower cash flows for environmentally friendly companies. We explored this latter possibility looking at analyst earnings forecasts. So in our empirical analysis, we use forecasts of earnings per share over the next 2 years and forecasts over long-term growth in earnings that represent the annual growth over the next 3 to 5 years. And we use the consensus forecast reported before the tax news and a month after the tax news event, so that we can compute the revision in earnings forecast. The 2-year forecast window covers the year before and after the implementation of the carbon tax, and the long-term growth give us a sense if investors are expecting this to be a persistent rather than a transitory effect. So let me show you the effect that we find in the level of earnings forecast. So what we find is that what we're interested is in this relationship between analyst revisions of earnings forecast and the firm's carbon footprint. Using this very simple linear regression model and controlling for many things, we find that the 1 standard deviation increase in carbon intensity leads to a downward revision of earnings in forecast of 3.3%. That's close to 1/4 standard deviation. When we look at growth, we find a similar result, which is this negative relationship between revision in forecast and long-term growth. These results suggest that the response of stock prices to the unexpected increase in carbon tax reflect to some extent revisions to the profitability of firms, with analyst pessimism about firms' profitability increasing with the firm's carbon footprint. Going back to the question in the title of the paper, should investors look through environmental ratings? The short answer is yes. And we use an event study approach around the significant and large unexpected increase in a carbon tax in Germany to show that environmental scores are not helpful in hedging climate policy risk for investors. In contrast, an investment strategy based on firms' carbon intensity, that seems to be a good hedge. If we look at evidence from earnings forecasts, we see that the value of low carbon intensity firms rises with the introduction of climate policies because it's possibly reflecting an increase in expected profitability. Overall, our findings, seem to point that deep decarbonization policies have the potential to have permanent effects on firm profitability.
So thank you.
I'll finish it there.
Yeah, thanks very much, Marcelo. I think we have time for a question, and one has come in. It came in from Philippe Wells, and it relates to something that I think a takeaway from your research is that it's important to be precise about the specific ESG measure that you're looking at. And I think what Philippe is asking is going in a different direction, kind of, horizontal. Like if you think of precision in the measure, you also think of salience of a particular topic by type of industry. So for example, carbon emissions may be salient for airlines in a way that it's not for other industries. Did you try doing any specific focused analysis by industry in this case?
So what we, in the paper, what we do, we have also like a more fancy cross-sectional regression where what we do is control for industry fixed effects. So what we're trying to capture is within industry variation. And that's where, we get the same result. But I think this is kind of a simpler way to show what like the main conclusion. I think like the main conclusion is possibly that the ESG scores are very noisy, and probably we're better looking at carbon emissions and any policies that incentivize firms to report their carbon emissions are going to be welcomed by investors and should be used.
Excellent. We are exactly at 5 o'clock or 4:59, and so I want to turn it back to Linda Bui. Linda, are you there to transition to the to the sort of, let people know what they can expect tomorrow. Thanks very much to our panelists in this panel. This has been fantastic. So thanks for everybody for taking part.
Hi, thank you, everybody. We are really excited to be wrapping up today's session. And we are very much hoping that you'll be joining us tomorrow. Please join us tomorrow at 9:15 for our next session entitled Private Equity Valuations and Market Dynamics. And until then, have a wonderful evening, and we hope to see you tomorrow. Thanks very much.